So Ryan Dietrich was pointing out the Santa Claus rally failed for the third year in a row. I think that's fascinating. Typically, that's supposed to be bad for the market for the year. It really hasn't been the last couple of years. We've had very strong years. And there were times where the Santa Claus rally was positive and next year was not so great. So is it a tell of the new year? Probably not as much as it's made out to be. It probably was more decades ago when there wasn't as much information flowing as there is now, but certainly worth noting. Some highlights of my conversation with Ryan Dietrich. OBBBA, the one big beautiful bill. Think of it as a front-end loaded fiscal policy, meaning that people are going to have money to spend in the short term. So that may be something that keeps the economy afloat a little bit longer than you might think. Or I know there's a lot of people who have a lot of negative opinions about this year. I do as well. I think there are things to be cautious about that we could see some problems coming in, but that could be something that pushes, as they say, kicks the can down the road a little bit further. And he did talk about how maybe we see a strong first half and a messy second half. That could be the opposite of what we saw last year. I think that's possible. So I'm really curious to see how that plays out. I will show you the seasonality about it as well. There may be record debt right now, sure, but there's also record assets, meaning there's record number of home ownership, stocks, cash on the sidelines, etc. And actually the balance sheets are positive in general for people, believe it or not. And a lot of people aren't feeling that, and I get that. That's the whole K economy thing. There's really two halves of it going on. But at the moment, the balance sheets are still okay for a lot of people. That's not great for some, but that is really what is holding this economy together for now. And that could stop at some point. The Federal Reserve cutting rates is historically bullish 1 year later. They started cutting rates last year. So for now, 1 year later, we might be strong for that. And that makes sense. A big one that he said I absolutely believe in is separate your politics from your market opinions, because they do not matter. We can show examples of every president for forever, and it probably went the opposite of where people would have thought. I mean, you can make money in pretty much every opinion. But what's most interesting, I think, is when Congress is split. Ryan was showing other data where a split Congress is actually one of the more positive times for the stock market specifically. And this is not talking economy, not personal, but the economy in general. So that's very likely what could happen in this next midterm election. If one side of the House turns back blue and the other side says red, we'll have a split Congress or a split government. And that's actually pretty good for the market because there's not a lot can happen in theory. I mean, that's a whole nother topic for another day. And then finally, he talked about the 6-year presidential cycle, meaning that the year 6 of a president tends to be positive, even though it's the second year of a 4-year cycle. Now that's super weird, and it's a super small sample size. There were really only four occasions, I believe, where that happened, but typically that is positive. So, but then the question is, well, it's not consecutive 6-year, it's actually a split. So we really haven't seen that. So we don't know. It's new territory, but it's something to think about, that typically the second term of a president tends to be a little bit different than the first. We kind of know what's going to happen. The market hates uncertainty. So those are the highlights that I got from that conversation. I thought that was really worth sharing, and I hope that helped you too. So seasonality of the past 6 presidential cycles over the past 25 years. So typically what happens, this is ignoring the 4 times that it was a 6-year, but this is typically the 4-year. The second half of January tends to be really ugly. We tend to get strength into March. We tend to get a slow grinding sell-off into the summer with a couple little rallies in August, and then there's almost always a rally in October through November. I don't know why that's just a thing, but usually we get a bottom somewhere in October and a rally into early November. And then this could be a Santa Claus rally there. The bias is negative. We start here, we end here. So there's a slow sloping hole. There's gonna be headwinds in the market, and that makes sense. But I think, like he said, I think maybe the first half stays strong. Maybe this whole period stays really strong, and then we see this push off into the second half of the year. It's very likely. Something to think about as we go forward. So my usual data, advanced decline is totally fine. We're above both trend lines, no issues. Money's coming into the market. That's the question. Is money coming in? That makes market prices go up. When money comes out, prices go down. It's really that simple. Following other things don't really matter because people vote with their dollars ultimately. So this is what I'm looking at here. Money's coming in, people are voting, we're fine. Even though the market's been a little bit choppy this week, there's really not been a lot of reason to be too concerned. And I'll show you in the other charts. Money flow has been slowing, but still positive, right? Still positive this week. We had a little green dot showing enough of a thrust off the bottom. We'll see what happens. There's a lot of mixed data right now, but so far this looks all right. We didn't dip down that far. Still positive, even though it is slowing. So that's something to think about. All market indexes that we follow are positive right now. They haven't been positive for too long either. So they're all above an 8-day trend. All over here, there's really not much to be concerned about, but the strength is where it's interesting. The ADX trend is the ones that have a positive confirmed trend. The other ones are a little just messier charts. So we've got emerging markets, developed, small cap, mid cap, and Dow, or those are the positive, confirmed positives. The Japan, Latin America, NASDAQ, S&P, China are all positive, but not as confirmed. So it's generally the overall opinion is positive for the market right now. Nothing to really be concerned about. On the sectors, that's where it gets a little bit interesting. Only 4 sectors are positive right now. It's financials, big shock, industrials. We're seeing more strength moving to the value side, and I'm going to show you that at the end. And it can be its own headwind into the market by itself. So that's something we're going to look at. But most of these are defensives or more value names. And when value leads, the market tends to not be as strong. The market can go up in that environment, but historically, it's not as strong. And I'll show you why in a bit. But yeah, all the negatives over here, we've got actually confirmed downtrends in a lot of the tech stuff right here. That's not super positive, but that could change tomorrow. It could change this afternoon. So it's short-term thinking. On the RRGs, again, we're showing a weird rotation. We've got energy pushing up the most. A lot of these are falling into the yellow, following from leading into weakening. We're seeing, weakness kind of come into a lot of the names, and that's not super positive on the market. Over here isn't too bad. What I always hope to see is that these get moved into the lagging, and then when they push up into the blue improving all together, if you see them all together, then we get a really good market run out of that. And I think we can get that set up in the next couple of weeks. If this weakness or sideways, boring, choppy market that we have can push a little bit further weakness without going down too much, that'll give us a great opportunity to really get aggressive, maybe in the second half of the month or maybe a little bit later. We'll have to see how that plays out. But right now it's a mess, and this isn't time to be buying. This is the time to be trimming. And we actually did a little bit of trimming earlier this week and a little bit last week, just, peel off profits a little bit because we could. And then new lows inverted. This is another one that just doesn't show any kind of problem. New lows. So how many new lows we're hitting on the New York Stock Exchange? And there's multi-thousands of stocks and issues on there and ETFs. But, if these are above 50, or we're seeing fewer than 50 of these hitting brand new lows, there's really not reason to be concerned about the stock market. There just isn't. Again, it's a money flow. It's money coming in. You don't fight that. But no new lows. We're not seeing them. We're seeing a little spike here. And as I said last time, in April, this thing shot up to about 1,000. So that was a problem. When you see a lot of money just exiting quickly for no reason, that's something to be concerned about. But yeah, for now, anything above this number, which is 50 or less, there's really not a lot of reason to be concerned. It's when we start pushing down into the red and then higher, then we're like, okay, that's an issue to think about. And then finally, this is something that I keep in mind a lot, and this is growth versus value. And I talked about that earlier when we were talking about the different sectors and what was strong and what was not. But this is a relative strength chart of growth, basically IVW, which is the growth, iShares growth ETF versus the IVE value ETF, right? And the ratio. So when this is going up, that means the growth stocks are beating the value stocks. The growth is beating value. And then if this is falling, value is stronger than growth. So what typically happens in here, the market, we had a very ugly market in 2022 when this was falling. We had these ugly periods right there, this very ugly period in 2025 around the tariff issues, right? You kind of see that coming. If value starts taking over, there's a problem. But we're kind of having a slow grind where value is stronger and the market's not really doing a whole lot. So I'm really curious to see if this can resolve itself and start pushing back up, or is this going to continue and then we may see something a little bit uglier, a little bit deeper, a little bit more concerning. But for now, we're just watching it. There's no crisis yet. It's just a very meh market. So until next time, that's what we're going to be watching.